Thanks very much, Jeff. So I'm going to start off just by highlighting some of the macro trends that we've seen in the asset classes, that being equities, taxable fixed income, muni debt, and money markets, and then just discuss in further detail some of the more interesting trends that we've seen develop here in the last quarter and for the full year. Tom, would you mind flipping ahead to slide 34 for me, please? Thank you very much. This slide here highlights the flows into the various asset classes: equity, taxable, muni, money market. Overall, for the quarter, we had another positive quarter of net inflows with 40 billion coming into mutual funds and 44.8 billion coming into ETFs. This mirrored the trend that we saw for the full year of 2013, which was a pretty robust year for mutual funds and ETFs overall, with 154 billion coming into mutual funds and 142 coming into ETFs. Equities were a solid contributor, both on the mutual fund side and on the ETF side, to the overall demand that we saw. Within the equity segment, which I'll get into further detail further into the presentation, we saw the majority of fund flows coming from the international equity sector, but we did also see positive flows in both U.S. diversified equity and in sector funds as well. When it comes to taxable fixed income, once again we had a negative quarter. This is the third quarter in a row that we've seen negative flows due to some of the points that Jeff discussed. Concerns about the Federal Reserve's bond purchasing program, where that might take rates, and investors reflecting upon the strong rally that we've seen in the equity market. So we saw some pretty strong outflows for the quarter in taxable. Much of that seemed to go into the money market side of the asset classes. We saw about 39 billion go into money markets for the quarter. Also within taxable, we did actually see positive net flows for the full year 2013. The majority of that coming from activity in the first quarter period prior to investors becoming particularly focused on the upcoming actions of the Fed. Muni debt, we saw another fourth quarter in the fourth quarter we saw another quarter of negative outflows. About 18 billion left the asset class during the period. Also for 2013, it was a record year of outflows from muni bond funds, with about 60 billion leaving the asset class in total. Largely due to some of the concerns that Jeff highlighted, the fiscal challenges facing the territory of Puerto Rico, Detroit filing for bankruptcy, concerns about the pension situation for the state of Illinois, gave investors pause to reflect upon the fiscal health of some of these municipalities and tax-exempt entities that are issuers in the sector. Money markets overall for the year saw a lot more activity, as I'll discuss further along, from on the institutional side in terms of positive net inflows. Retail was largely flat for the year. Jumping ahead to slide 35, just a little bit more detail on what went on in the equity mutual fund space. In the U.S. diversified equity space, we did see positive flows for the quarter, with 8 billion coming in and about 50 billion coming in for the full year 2013. Here we saw most of the demand on the positive side coming from investors seeking alternative products, in particular long-short products. Also saw a continuing demand for yield, investors seeking out equity income products, as well as multi-cap core products, and those were largely index funds issued by Vanguard, the Total Market Index Fund, and the Fidelity Spartan Total Market Index Fund saw particularly strong inflows for both the quarter and the year in that sector of U.S. diversified equities. Within U.S. diversified equities, as the largest outflows were continued to be witnessed in the growth sector. Investors seem to have a bias against that during this quarter and for the full year, moving away from particular actively managed growth products. Within sectors, we saw the strongest demand. Demand overall was positive, about $3 billion for the quarter, about $23 billion for the full year. Sectors that investors favored the most were amongst the strongest performing ones, those being healthcare, biotech, up strongly for the quarter and for the period. Investors seeming to like some of the changes and the prospects of some of the corporations in those sectors with the ongoing debate and implementation of Obamacare. We've also seen some strong flows into science and technology funds, mirroring the performance of the NASDAQ, particularly in the fourth quarter, where the NASDAQ was up strongly, almost 12% for the period, up almost 40% for the year. Outflows, not really too surprising within the sectors. We're seeing in commodities, natural resource, in real estate, investors thinking that the commodity boom cycle that we've seen over the last decade or so has come to an end. Seen declining demand for commodity prices, and energy globally has also suffered due to the shale, partly due to the shale natural gas boom witnessed in the United States. Within the world sector, world equity continues to attract robust demand from investors. Strong flows were seen into passive products within the sector. The Vanguard Total International Index Fund was one of the most one of the most robust in terms of positive net inflows for both the quarter and for the year. Investors still have an affinity for emerging markets products, despite the relatively weak performance over the last 12 to 18 months of the sector. Investors searching for perhaps value buy there, waiting for a turnaround in several Asian countries that hasn't yet materialized in terms of performance. Sectors that have suffered in this sector, in terms of world equity, have also been in the growth area. Large cap growth, in particular, saw some pretty strong outflows for the quarter, as well as for the year. We've also seen that in regional funds. China and India and Latin America have also witnessed outflows for the quarter and also for the year. Moving ahead to slide, I believe it's 36, just to look at how some of the larger equity ETF fund flows have been over the recent quarter and also for the year. As we know, the equity ETFs tend to mirror the activity of institutional investors. It does seem as in the fourth quarter, investors seem to buy into ETF. Investors seem to buy into the equity rally that has been ongoing domestically during 2013. We see SPY, the largest ETF, that's the State Street S&P 500 product, witnessed strong inflows during the fourth quarter. About $13 billion came in during the fourth quarter. That's on top of about $5 billion during the third quarter. Additionally, we see with EFA, the iShares MSCI EFA product, strong inflows there during the period. EFA had a solid quarter. The index was up 5.75%. We had about $4.5 billion come into the ETF during the period. This is on top of pretty strong inflows during the third quarter as well. Investors liking QQQ as well, the PowerShares QQQ ETF, which tracks the NASDAQ 100. NASDAQ, as I previously mentioned, had a very strong quarter. It was up about 12% for the period. Very strong year as well. About $2.5 billion came in during the quarter into that product. EEM, the emerging markets ETF, the iShares product, had volatile flows during the 2013. For the quarter, it actually witnessed some outflows as uncertainty about emerging markets has started to weigh a bit upon ETF investors. This is following a positive third quarter. About $2 billion came out of the product during the fourth quarter. For the year, we did see some pretty volatile flows, as you can see on the graph. The first and second quarters, we saw flows gyrate pretty significantly week to week, finishing the year flat. No surprise, GLD, the Spider Gold ETF, also witnessed another quarter of outflows as price of gold has continued to decline. It saw outflows every quarter during 2013. The gold ETF actually had net outflows of about $4.2 billion for the quarter and lost $24.9 billion for the full year 2013. Moving ahead quickly to the next slide, just a quick look at how equity fund flows have been in terms of gainers and losers, in terms of classifications. Sort of touched on a lot of this already. Big gainers were the U.S. diversified equity. Within U.S. diversified equity were the multi-cap core products, the long-short sectors, healthcare, biotech. These are obviously some of the strongest performers. When it comes to world equity, investors still seem to appreciate emerging markets. And the international large cap cores we touched upon is largely ETFs indexing from Vanguard and Fidelity. So some of the losers within large cap were large cap growth within U.S. diversified equity, and once again some of the underperforming sectors, natural resources, precious metals, gold, etc., were some of the losers. The following slide, number 38, just lists in terms of top 5 classifications and bottom 5 classifications, what witnessed the most inflows and outflows. Just some of the more interesting names within these areas would be within the institutional money market space. Probably no surprise, but there were very strong inflows into the product, as it seemed some institutional investors during the fourth quarter became concerned about what the Fed might do, so they were apparently parking money in cash. BlackRock, Wells Fargo, B of A were the largest recipients of these movements. Investors desired to go short duration, as witnessed here with the low participation category seeing some of the strongest inflows. The big gainers there were Oppenheimer, Eaton Vance, Ridgewood, and Fidelity. The Oppenheimer fund actually had about $5.5 billion come in during the full year 2013. The emerging market space, some of the big gainers there in terms of funds were probably no surprise. The PIMCO EM Fundamental Index Fund took in about $2 billion during the quarter. Oppenheimer Developed Markets Fund also did well, and the JP Morgan Emerging Markets Equity Fund took in about a little over $1 billion as well during the period. Some of the losers were in the investment grade space. The intermediate, longer maturity, longer duration space continued to see outflows. Some of the funds that saw the largest outflows during the quarter were the Delaware Term Limited Dividend Income Fund, which saw about $200 million come out. The Fidelity Intermediate Bond Fund had about $140 million come out. American Funds Intermediate Bond had about $114 million come out. TIPS have also continued to see strong outflows, almost $11 billion leaving the asset class during the quarter. There we see Fidelity's Series Inflation Protected Bond Fund was one of the largest recipients of net outflows. Vanguard Inflation Protected, PIMCO Real Return all saw pretty strong outflows during the quarter. Multi-cap growth continues to see strong outflows as well. Some of the bigger names there that have seen strong outflows during the period and for the full year: Fidelity Growth Company, Fidelity Blue Chip Growth, Vanguard, Morgan Growth, all the top 3 losers in that classification for the period. Contra funds in the large cap growth spectrum sector actually saw about 584 million come out. American funds, Growth Fund of America, was also a loser of assets as well. Moving ahead to slide number 40, just a quick look at how we did in terms of taxable bond fund flows during the quarter. No surprise, really. Some of the shorter duration plays saw the most assets flow in. These would be the loan participation category. Almost $8 billion came in. The short investment grade debt also saw strong outflows, as did the ultra short funds and high yield. Just sort of strong on the backs of pretty strong total returns witnessed in the asset class during the quarter end and really for the full year. Some of the larger beneficiaries in terms of fund companies were, as you might suspect, in the loan category, Oppenheimer, Eaton, and Fidelity. In the short investment grade debt category, we saw Vanguard short debt taking about $960 million. Lord Abbett short duration took in $506 million. DFA, one-year fixed income, took in $489 million. T. Rowe also saw some pretty strong inflows. In the high yield sector, T. Rowe Price High Yield continues to see very strong inflows. About $1.5 billion came in during the quarter. BlackRock High Yield took in about $660 million for the period. In the longer duration products that saw some of the largest outflows, the Fidelity Intermediate Bond, about 140 came out. American Funds Intermediate Bond, about 120. So that sums it up for the fixed income side of the house. In terms of muni bonds, as I mentioned, it was a record year of outflows. That trend continued in the fourth quarter. Some of the state funds that lost the most, no surprise, largely just based on the sheer size of the asset base and number of shareholders, were the Lipper California Muni Debt Funds, New York Muni Debt Funds, Pennsylvania, Massachusetts were the top four losers in terms of state muni debt funds. In the following slide, just briefly touching on money markets, one of the more interesting highlights there was the move away from tax-exempt money markets to the benefit of the taxable side. Seemed as if retail investors were largely leaving tax-exempt money market funds for the perceived safer haven of the taxable sector. So going forward, it will be interesting in 2014 to see if equity fund flows do pick up on the heels of one of the strongest domestic equity rallies that we've seen in the last 15 years, and also if this emerging market trend and affinity for it by investors will continue. So that will be two interesting trends to watch, and certainly will be whether the muni bond fund flow trend of negative outflows continues or it abates somewhat, and also what goes on with taxable bond funds in general, if investors will be enticed back in with higher yields. With that, I'd like to turn it back to Tom.
All right, thank you very much. I appreciate that. It's good having you join the team, Barry. We appreciate your presentation, and I'd like to thank everybody for attending this morning. But we certainly are able to take questions if you have any questions. We'd love to see that in the chat. And like I said, Barry, for Jeff or myself, if not, while you guys are typing that up, I just want to remind you that we will be sending the WebEx out in a PowerPoint presentation, actually PDF'd shortly. It'll be out in the next hour or two. Also, I will be posting the replay to the web, again, hopefully by Friday. Worst case, maybe over the weekend or early Monday morning. We would really enjoy seeing you guys at our next WebEx presentation, which is now scheduled for Tuesday, April 8th at 2014 at 9 o'clock in the morning Mountain Standard Time, 11 Eastern Standard Time. And the last piece, remember that I did say at the beginning of the presentation that we intend on sending out a survey, and Jeff and I and Barry and the rest of the research team would really appreciate your candid review of how the presentations are going, what you'd like to see, what we can do better, and the like. So again, check your inboxes over the next week or 2 or 3, and we'll certainly have that out to you. And if you haven't visited our site at lipperinsight.thomsonreuters.com, we put up weekly pieces, some of it's commentary on alternative funds or flows or whatever the case may be. So we have Andrew Clark, myself, Jeff, Barry, the head of our research, Bob Jenkins. He's adding segments to it as well. So again, we'd love to have you jump on that site. Again, lipperinsight.thomsonreuters.com. And let's see if there's any questions that have come in. And none. All right. Well, again, we'd like to thank you for joining us, and we look forward to seeing you at the next presentation. Thanks again.
Well, yeah, if Barry